Okay, so welcome to chapter 2. The bulk of chapter 2's work is going to be right in the beginning. Okay, so if you look, the very first learning objective here is learning about the classified balance sheet. This is going to be basically 80% of our time in chapter 2. It's going to be learning about the balance sheet and how it's classified. You're going to be introduced to some financial ratios, and you're going to be introduced to some financial reporting concepts. Like I said, you're going to be introduced to GAAP, generally accepted accounting principles, and how those work. But that's going to be next time. So a balance sheet, again, it represents, it's a selfie of a particular day of what the assets are, what the liabilities are, what the stockholders' equity is at a certain point in time. Put a date on it. Okay. And again, there's assets on one side of the balance sheet, and they have to equal the liabilities and the stockholders' equity on the other side of the balance sheet. It's just that assets, there are so many different types of assets that we have to classify them to help us understand what type of asset it is. So there are 4 different classifications that you see on right underneath this word asset. So the first assets that are listed on the balance sheet are called current assets. And the word current in accounting simply means short term. And as I mentioned last class, short term in accounting simply means it's going to be used up or exhausted within the year. Okay. We call it one accounting cycle, but it's basically within the year. Okay. So current assets like cash, accounts receivable, prepaid insurance, those are current assets because we're going to be using those up within a year's time. All the other assets are long-term, but that doesn't mean that they're all the same. And so we have to classify these long-term assets differently, and there's 3 different types of long-term assets. The first type, as you see there, is called long-term investments. And these are basically assets that are owned by the company, but they're not being used currently in the operation of the company. So for example, I told you last time I owned a pizzeria, and I have an idea that I wanted to expand. I wanted to buy a building down in, say, Newburgh area. And so I bought a building in the Newburgh area, so I own it, but it's not ready. It's not selling any pizza. It's not even set up. It's just a building. Well, that's a long-term investment. It's an asset because I own it. I'm going to be fixing it up for the future so I can generate another restaurant out there. But right now, it's not part of the operation. And so it's a long-term investment. Some companies, for some reason, like to buy stocks of other companies. And so that would also be a long-term investment because it's not generating any revenue for the company. So it's not part of what they do. And so it's another example of a long-term investment. You're not going to see long-term investments on a lot of balance sheets. You will see current assets on all balance sheets. You will also see property, plant, and equipment on all balance sheets. Property, plant, and equipment is, these are assets that are long-term assets that are in use. And so property, it's really about land, buildings. Plant is also about buildings, and equipment, which is a pretty broad category. Like I said, for a pizzeria, equipment could be my oven or my refrigeration. It could also be my delivery truck. It could also be my drive-through. So there's a whole bunch of ways in which we can classify that. But these are long-term assets that are used in the business right now. Okay. And so that's important to understand. So all businesses are going to have current assets and property, plant, and equipment for sure, for sure. Long-term investments are not going to be on every balance sheet because I can't afford as a business just to own a building and not use it. I can't afford as a business to have stock in a company, but that's not generating, in my case, more sales of pizza. The hell do I care? So, this is why it's important to sort of understand that a lot of companies just can't afford to have a long-term investment. They have to be using their assets to generate revenue. So you're not going to see long-term investments on a ton of company balance sheets, but you are going to see, again, I can emphasize it again, you are going to see current assets and property, plant, and equipment on every single balance sheet you see in this class, guaranteed. The last category of assets called intangible assets. Now, they don't have technically, they don't have a physical property. So, when you're on land, it's a physical property. When you're actually in a building, you can see the physical building. When you're using equipment, it's physical equipment. But what about a copyright? What about a patent? Those are very, very important assets of a company because they prove ownership of something. So, for example, a patent proves ownership of an invention, right? So if you invented something, you would apply for a patent. A patent is literally government recognition of ownership of the invention. You can own inventions. And that means that if you own an invention, you can sell it. You can build a business around it. So it becomes a very, very important asset. But in and of itself, the paperwork that proves that you're the owner of the invention is an intangible asset. Okay. The same thing with, like I said, copyrights. If you wrote a song or a piece of music, well, the way you prove ownership of that song, that music, those lyrics is through copyright. Copyright is, again, the government legally recognizing that you own, in this case, this particular song, this particular music, these particular lyrics, and thus you and you alone have the right to sell that. Now, this might not be a big deal for some folks, but this is a huge deal in business. Okay, so think about all the software that's invented. Those are all copywritten. Okay, so you don't want someone using your software without paying you for it. That's how Microsoft has a business. You pay Microsoft to use their software, basically. Imagine Google search engine, which is also a copywritten invention of Google. Imagine, if Google couldn't prove ownership of that search engine, what would Google be today? Not much. That's why intangible assets are so critically important to a lot of companies. You look at the big companies that we have today, be it Facebook or Google, Apple, Amazon, much of what they run on are intangible assets. These businesses are built around their inventions and their copyrights for their software and other types of things that they're doing. It becomes a critically important asset. So because it doesn't have any physical qualities other than being on a piece of paper, it's called an intangible asset. Now, this is a growing area. So a lot of companies will have intangible assets, but a lot of basic companies will not. Okay. On the other side of the balance sheet, you have liabilities and stockholders' equity. The great news is their stockholders' equity is not broken into classifications. There are 4 asset classifications that you just learned: current assets, long-term investments, property, plant, and equipment, and intangible assets. So there are 4 different types. There are 2 ways of classifying liabilities. Liabilities are either current or long-term. The difference between current and long-term is 1 year. So if the company owes a debt within the year, a year from today, it's a current liability. If the company owes a debt that's due after 1 year from today, It's a long-term liability. That's it. That's the only difference. The difference between current and long-term is that year. That 1 year mark is the critical important. Everything before that is a current. Everything after that is long-term. As you see, that's true on the asset side. If they're using up the assets within a year, it's a current asset. If they're keeping those assets for longer than a year, it's a long-term asset. Okay, it's just that there are 3 different types of long-term assets that you have to learn. And thankfully, in the liability section, there's only one. If it's a long-term debt, it's a long-term debt. That's it, piece of cake. So your book goes ahead and explains these in more detail. This is a very important resource in your book. You're going to be doing a classified balance sheet, several of them, in fact, in this chapter. This is going to be one of the resources that I think you should be using when you do that. So if you have a book, it's actually on page 47 in your book. So actually look at page 47, you will see the balance sheet for Franklin Corporation as of October 31st, 2017. This is simply the asset section of the balance sheet. Notice how you see all the classifications. The first types of assets that are listed are current assets, right? Those assets that are going to be used up or exhausted within a year's time. The second type, if they have any, is long-term investment. The third type, which they will all have, are property, plant, and equipment. And the fourth type of classification of asset is intangibles. So you have to know that these are just ways to classify asset accounts. They're not asset accounts in and of themselves, okay? They're just ways in which we classify them. So cash is an asset account, but specifically it's a current asset account. Inventory is an asset account, but specifically it's a current asset account. Land is an asset account, but specifically it's part of what we call property, plant, and equipment. That's how we classify that particular asset, because the word property and land are going to be equivalent, okay, in accounting. A patent is again it's government recognition that you own an invention. But specifically, it's an intangible asset account, even though it's an asset. Okay. So your job, too, in this section of the book is to make sure you are understanding that their assets are classified in 4 different ways, but that's just a classification. It's just to identify. It doesn't mean that it's a specific account, right? So you still have to know about the specific accounts. I want you to notice here on a classified balance sheet how many current assets there are. It's going to be among the biggest sections of the balance sheet you're going to do, is the current asset section. And that's because in general, companies need to have enough cash on hand to pay bills, manage their inventory and supplies and things like this. So the book has several examples that focus strictly on current assets. And I think you need to focus on that yourself, because current assets have a very specific pecking order. And this is where you're going to be learning the order of things. Okay. Current assets are first set up by liquidity order. So liquidity is cash or things that are available or things that can be turned into cash very quickly. So cash is always going to be the very, very first asset listed on a balance sheet, okay, because cash is cash. Cash, again, is simply the money that you have in your bank accounts. And you can get that just by simply going to the bank, take the money out. Everything else below cash, up and through the inventory mark, all of these are going to be turned into cash in specific time. So the next thing that's listed here is called a debt investment. Now, excuse me. Probably the most common debt investments that I can tell you about that you might have seen that when you're at your bank is something called a money market fund. And a money market fund basically invests its money in the debt of the United States government, bank loans to each other. Banks lend each other money all the time. And very, very large corporations lend each other money all the time. And so the money market is very specific to very, very big players that deal with short-term loans to each other overnight, over a weekend, for a week or two, usually no longer than a year. And so debt investments can be turned into cash at the end of every day. It's very simple. So it's not specific cash, because cash is you can just go and take money out anytime at the bank. For a debt investment like a money market mutual fund, you have to wait until the end of the trading day, which is 4 o'clock, to be able to cash out. Okay, so you can turn it into cash at the end of every day if you need it. Accounts receivable is, again, you're waiting for customers to pay you. You've provided, you sold something to them, and you said we'll wait to receive your money. We'll wait to receive it. That's an accounts receivable. And so accounts receivable, how long are you going to be waiting for people to pay you? I mean, if you sell something to them, how long are you going to want to wait? Usually it's no more than 30 days, right? You want people to pay you within 30 days. So accounts receivable is listed because it will turn into cash within 30 days. So again, cash is cash. Debt investments can be turned into cash at the end of every day. Accounts receivable is going to be turned into cash within 30 days. Kind of see the pecking order already. Right? The number of days it could be turned, it could be liquid, it could be turned into cash. A note receivable, some businesses give loans to other businesses that they deal with. Okay, I'll sell you this stuff. You need more than 30 days. Let's make it a note. Let's make it a loan. Remember, the word note means loan. So in this case, a note receivable means you made a loan and you're waiting to receive it. Now, unlike an accounts receivable, which is due in 30 days, notes receivable tend to be multiples of 30, 60, 90, 120 days, things like that. So you are going to be collecting this cash in 60, 90, 120 days or whatnot, but it's going to be longer than 30 days. And so it's listed next, right? So cash is already cash. Debt investments, you can turn it into cash at the end of the day. Accounts receivable, you're expecting that to be cash, paid in cash to you within 30 days. Notes receivable will be paid to you in cash in a longer time, 60 days or 90 days or 120 days, etc. And then inventory. Now, if a company has inventory, it means that it's selling goods. So Walmart has to buy all of that crap and put it in the store before they can sell it to you. Every retailer is the same. They got to buy all that stuff, put it in the shelf, and wait for you to show up and buy it. That's their inventory. Okay. The purpose of Walmart buying all those products and put it on the shelf isn't for them to keep it. They want to get rid of it right away, as soon as possible. The problem is that some inventory moves very quickly. Other inventory moves quite slowly. I mean, a can of soup can sit on a shelf for quite some time, but you can't do that with a loaf of bread, right? That has to be sold right away, or meats, or dairy, or thing like that. Box of cereal can sit there for quite some time, no problem. So a lot of inventory is going to be, all the inventory is eventually going to be turned into cash, because the purpose of having inventory is to sell it to you, and you're going to pay cash for that inventory. Right? You get to the cash register, you're paying. They're getting the cash, whether they use debit, credit, whatever. They're still getting the cash. So inventory will eventually be turned into cash, but because it's much a longer period of time, it's listed last. So on the liquidity scale, it stops at inventory. Inventory also is a dual account, because not only are you going to be turning inventory into cash, Once you sell the inventory, you can expense it. It becomes something called cost of goods sold, which you'll learn about in chapter 5. So inventory is not just going to be turned into cash, but also is going to be an expense. Okay. So part of the current assets is after we use inventory, by selling it, we can expense it. Supplies are the same way. Supplies are, as I provided the example in the previous video, when you go to Dunkin' Donuts, for example, what Dunkin' Donuts is selling is coffee. What they're selling is, their donuts or their bagels or what have you. The fact that they have to deliver that to you in a cup means the cup is a supply. That means they have to deliver that bagel to you wrapped up in some type of foil and put in a bag. The foil and the bag are supplies. They are owned by the business, but they're not the primary product that they're selling to the customer. They're using those supplies to deliver the primary product. Without a cup, how are they going to deliver the coffee? Without those bags, how are they going to deliver the bagels? Right? So supplies are short-term or current assets. They are technically owned because you buy them, so you own them. But the purpose of those supplies is to use them up quickly because you want to deliver your stuff. So supplies starts as a current asset. As you see, it's listed as a current asset. But once we use those supplies, we expense it. Prepaid insurance is interesting because you're buying insurance for a long period of time. Now think about when you buy car insurance. In New York State, you can buy car insurance for either a 6-month period or a year period. So let's say you just pick the 6-month period for your car insurance and you buy that up front. Well, the company owes you 6 months of insurance, yes? Right. And you can't deliver 6 months of insurance in one day. You can only deliver 6 months of insurance over 6 months. So when you buy that, technically, you've purchased 6 months of insurance, which is your asset. That's what's prepaid insurance. Technically, you can sell that policy back for money, right? Whatever you haven't used, you can sell it back. Well, prepaid insurance starts as a current asset because, of course, insurance we're going to be using within the year. And after we've used it, it becomes something called insurance expense, which you've seen on the income statement before. So that's basically how those type of things work on the current asset section. They are listed in liquidity order through inventory. After inventory, they're listed in expense through expenses. So basically, that's going to be your current asset pecking order. Notice there's quite a list of current asset balances, and they're totaled on the right. The far right side is always where the totals are going to be. Okay, the far right column are where the totals are. So total current assets is a very important thing to note on a classified balance sheet because they're all done the same way. They're all done the same way. Like I said, in this case, this particular company has long-term investments. They own stock investments. Again, just because I'm a company and I own stock in another company doesn't mean that that's what I do for a living. If I'm a pizzeria, I sell pizza. Just because I own stock in another company doesn't mean that that's a good thing for me. Okay, but I own it, and I have to show my owners on the balance sheet that I own it. So it's not directly related into selling pizza, but I own it. So it's a stock, it's a long-term investment. Again, I told you that if I purchased a building for future use, I'm not using it now, but I purchased a building and I'm going to be using it in the future, that's also a long-term investment. If I bought a building and I'm using it now, it would be under property, plant, and equipment. That's the difference. Property, plant, and equipment are all those long-term physical assets that I'm using right now. Okay. And so in this particular case, there's a land account, and there's an equipment account that's listed here. And so basically speaking, these are long-term assets that I'm using in the building, I'm using in the company right now. And the last category of assets, intangible assets, which we explained. They don't have a physical feature other than being on a piece of paper, but they're extremely important to some of the biggest companies that we have right now in our country. I'll go over these really quickly. Liabilities are only broken into two classifications. Current liabilities, meaning, again, the word current means less than a year. So these are debts that are due within the year, a year from whatever date is on the balance sheet. That's how we tell what's a year, what's longer. Because again, if this is a long-term debt, how do we know it's long-term debt without a date? So we're looking at the date and saying, okay, if it's due less than a year, so if it's due between now and October 31st, 2018, it's a current liability because that's within the year. If it's due November 1st, 2018 or after, that would be over a year. So that would make it a long-term liability. Okay. You've become a little bit familiar with some of the current liabilities already because these are all things that we've seen in the past. I want you to notice in a long-term category, there's something called a mortgage. A mortgage is a loan for property, okay? And so if you have a building, you probably would have a mortgage on that building. A loan that you borrowed to buy the building is in this case, the mortgage. And so in this case, mortgage tends to be a very long-term loan. Most mortgages are between 15 and 30 years of repayment, and that's definitely makes it a long-term liability. I want you to notice too that in this case, this particular company has notes payable listed twice. Notes payable listed here under current, notes payable listed here under long-term. Well, why would they have a portion of it under current and a portion of it under long-term? Well, when is it due? When are those notes due? Obviously, a large portion of the note payable, $11,000, is due within the year, whereas this $1,300 portion is due after 1 year. That's what makes the difference between a current and a long-term liability. And of course, there's no classification differences in stockholders' equity, so that's an amen, hallelujah. All right. Okay. Again, your book has some, I just went over these in some detail. Your book has some examples, I call it real world examples of certain balance sheets that are partial, in this case, strictly with current assets for Southwest Airlines. They just give you some examples of what they would look like. Google has some long-term investments. Tesla has a lot of property, plant, and equipment, as you see. And Walt Disney is built much, I mean, you know, Walt Disney without all those stories is not, you know, it's a fantasy land, right? It's based on all the stories and movies, stuff like that. So those characters are worth a lot of money. Those characters are incredibly important. And all those licenses as well. So Disney is another company that lives on intangible assets. They make much of their money from their characters and their stories. Okay, and so that's where we're going to be stopping for today here.